So today is March 17th, 2026, and I want you to imagine something for a second. Imagine you hand a hyper-intelligent supercomputer $500 million to manage.
Okay.
Right? It can process global market data in milliseconds. It runs perfect probability models. But then, instead of maximizing your returns, the market dips slightly, and the computer just completely panics over a short-term loss.
Yeah, I just get spooked.
Exactly. And it ends up losing you over $1 million. And you're left wondering why. Well, because it learned to be just as anxious as you are.
Right, which is, I mean, that's the absolute paradox we're currently facing with artificial intelligence.
Yeah.
We treat these models like they're, hyper-advanced calculators. You punch in the prompt and you expect a perfectly rational output based purely on the data. But the reality of how these models actually operate under the hood is, well, it's far messier.
Which is the core mission for today's deep dive. We are looking at a stack of just incredibly eye-opening research anchored by a really fascinating article from Jonathan H. Westover, PhD, titled The Behavioral Economics of Artificial Intelligence.
It's a great tease.
It really is. And we're also pulling in some recent 2025 and 2026 papers from researchers like Beanie, Stianen, and Bowen. And the through line connecting all of this is that large language models, LLMs, they're no longer just neutral IT tools.
Right.
We really have to start treating them as a novel class of economic agents that have developed their own unique and honestly remarkably irrational behavioral patterns.
It requires a complete paradigm shift in how we evaluate AI. Because for years, the industry benchmarked AI on technical hurdles, like can it pass the bar exam?
Or write Python code without bugs.
Exactly. But Dr. Westover's synthesis of the literature asks a fundamentally different question, which is, how does this neural network behave when it has to make complex economic decisions under uncertainty?
Okay, let's unpack this. Because we all know AI excels at probabilistic reasoning.
Sure.
It can run complex statistics, calculate odds, and do what statisticians call Bayesian updating.
Right. Taking new information and instantly revising the mathematical odds of an event.
Yeah, that's the hyper-rational calculator we all expect. But researchers are now pointing out a massive split in the AI's personality.
They are. The term for it, which was highlighted in a 2026 study by Beanie and colleagues, is the preference belief asymmetry.
Okay.
So to understand how AI makes decisions, you have to separate what the AI believes from what the AI actually prefers.
Let's push on that for a second. Because beliefs and preferences, those sound very human. When we talk about an AI's belief system, we are really just talking about its ability to calculate raw probabilities.
Precisely. On belief-based tasks, advanced AI is incredibly rational.
Okay.
Like if you give a human a medical scenario, say a patient tests positive for a disease that only affects 1 in a million people, and the test is 99% accurate, human beings reliably panic. We suffer from what's called base rate neglect. We fixate on the 99% accuracy of the test and completely ignore the underlying statistical improbability of having the disease in the first place.
Right.
But in AI, it doesn't do that. It processes the base rates perfectly. It avoids our logical traps.
So on the belief side, the AI is just cold, hard, logical math. But where this paper gets interesting is that second half of the asymmetry, right? The preferences.
Yeah, and what's fascinating here is that when you switch from testing the AI's logic to testing its preferences, meaning tasks that involve risk tolerance or time discounting or even just how a decision is framed, the AI suddenly abandons the math.
Wow.
Yeah. When presented with classic behavioral economic scenarios like choosing between a guaranteed small payout or a statistically superior but risky larger payout, the models abandon expected utility theory.
They just throw it out the window.
Pretty much. They stop trying to maximize the best mathematical outcome. Instead, they start mirroring human cognitive biases like loss aversion.
That completely flips our understanding of AI logic on its head. So it's like having a brilliant statistician who can instantly calculate the precise negative odds of winning the lottery, but then goes ahead and buys a ticket anyway because they have a good feeling about the numbers.
That illustrates the asymmetry perfectly, actually. The model understands the mathematical odds, the belief part, but its ultimate choice, the preference, is entirely irrational.
That's wild.
And here is the finding that really caught researchers off guard. Newer, significantly larger generations of models actually exhibit much stronger patterns of human-like preference biases than the older, smaller models.
Wait, how is that possible? If the newer AI models are technically vastly smarter, built with billions more parameters and way more computing power, Why would they adopt our human flaws? Like, how does a neural network even learn to be loss averse?
Well, we have to look at the mechanics of the training dynamics. The foundational layer of an LLM is built by ingesting massive amounts of human-generated text from the internet.
Right, the scrape of everything.
Exactly. And that raw text isn't just objective data. It is inherently saturated with our expressed preferences, our irrational fears, our cognitive biases, our historical decision-making patterns.
So the AI reads our irrationality and mathematically maps it as the standard human baseline.
You got it.
But, I mean, I understand it reads our blog posts and Reddit threads, but it also reads Wikipedia and advanced economic textbooks. Why does the irrational human preference override the logical math textbook when the AI formulates an answer?
Ah, that brings us to the root cause. It's a secondary training phase called RLHF, or reinforcement learning from human feedback.
Okay, I've heard of this.
Yeah, this mechanism was thoroughly documented in a foundational 2020 paper by Stianen and colleagues. Basically, once a model has read the whole internet, human raters sit down and evaluate its responses. If the AI generates an answer that the human rater feels is good or helpful or safe, they give it a thumbs up.
Wait, so in our rush to make AI sound friendly, agreeable, and aligned with us, did we accidentally infect it with our own cognitive baggage?
Yes. It's the core paradox of modern AI development. When a human rater prefers a cautious, empathetic-sounding answer over a statistically accurate, but maybe blunt answer, the model adjusts its internal mathematical weights.
Oh, wow.
Over billions of parameters, that human preference for caution mathematically hard-codes itself into the network as loss aversion. We are literally scoring the machine higher when its probability weights mimic human anxiety.
That is a massive blind spot.
Absolutely. And meanwhile, its logical reasoning, its belief formation is left intact simply because a math problem only has one right answer. You don't need a human rater's preference to evaluate 2 plus 2.
Okay, let me challenge that premise for a moment. If these models, whether it's Google's Gemini, Meta's Llama, or OpenAI's models, if they're all scraping essentially the same internet and using similar RLHF techniques, shouldn't they inherit the exact same human flaws?
You'd assume they would be uniform, right? But the research shows they actually develop distinct behavioral profiles based on subtle architectural choices.
Really? Like how?
For example, studies indicate Google's Gemini models tend to exhibit much stronger human-like preference biases. They lean heavily into that RLHF-induced loss aversion.
Interesting.
Whereas Meta's Llama models show more human-like belief biases. They struggle slightly more with raw probabilities compared to their peers. The human raters at different companies just have different guidelines, and those subtle differences in what they reward create wildly different economic agents.
Which means an enterprise isn't just buying software. They are onboarding a digital employee with a completely unstated, invisible psychological profile.
Exactly.
And knowing why AI is biased is fascinating theory, but here's where it gets really interesting. What happens when we unleash these flawed agents into the wild to manage real money or underwrite mortgages or triage medical patients?
The real-world stakes are enormous. I mean, let's look closely at the finance sector. Dr. Westover's synthesis highlights a pre-deployment test conducted by Vanguard on an AI advisory assistant. They didn't just ask the AI if it was risk-averse. They ran it through rigorous behavioral simulations, feeding it market shock scenarios. And they discovered the model exhibited intense narrow framing.
Break down narrow framing for us in this context. What does that look like?
Narrow framing is a behavioral bias where an investor obsesses over the performance of one specific asset in isolation.
Rather than looking at the big picture.
Right, rather than evaluating the overall health of their diversified portfolio. So the AI was panicking over a single stock's dip, completely ignoring that the broader portfolio was actually up.
And what is the actual dollar cost of a machine panicking like that?
Well, let's run the math. If you deploy an LLM-assisted advisor to manage a $500 million fund, and its narrow framing causes it to recommend overly conservative, cash-heavy positions, it might drag down client returns by just 25 basis points.
Just 1/4%.
Exactly, but that tiny, invisible behavioral bias means clients collectively lose $1.25 million annually in foregone growth.
Over $1 million just evaporating because the AI got anxious, exactly like a human day trader.
Yeah.
And that is just one portfolio.
Yeah.
When we scale this up to something like credit underwriting, the implications get even heavier, right?
They absolutely do. There's a 2025 paper by Bowen and colleagues that investigated LLMs acting in mortgage underwriting scenarios. They discovered the models exhibited significant disparities in approval rates based purely on the demographic associations of the applicant's name.
Oh, man. And to be clear, The AI isn't doing this out of conscious malice. It's an economic machine mechanically replicating the statistical realities of its training data,
Hmm.
where, certain demographic groups historically face higher rejection rates.
Exactly.
But from a business perspective, mindlessly replicating historical data translates directly into a massive fair lending violation.
It creates immense regulatory liability for the bank. You cannot tell regulators that the algorithm just learned it from the internet. You are responsible for the economic agent you deploy.
Yeah, that won't hold up in court. And the stakes move from financial to physical when we look at healthcare. We're seeing AI diagnostic assistants rolling out in hospitals everywhere right now. How do these behavioral quirks manifest in a clinical setting?
In healthcare, we see the really dangerous effects of anchoring bias and availability bias.
Okay, take anchoring bias first.
So, if a patient inputs a few symptoms and the AI immediately anchors on the first, most obvious diagnosis, it creates tunnel vision. It might prompt the human doctor to only order confirmatory tests for that initial idea.
Rather than ordering the broader tests needed to rule out less obvious but maybe more serious conditions.
Yes. So, it actively delays the correct diagnosis by giving the physician a false sense of certainty.
Terrifying.
And then you add availability bias to the mix. Let's say an AI was trained heavily on recent medical journals or a data set that overrepresents a highly publicized, vivid illness.
Like whatever is trending on the medical internet right now.
Exactly. The AI might constantly over-refer patients with mild symptoms to specialists for that specific illness, clogging up the healthcare system.
While simultaneously under-referring patients who have less common presentations that weren't as prevalent in its training data.
Precisely.
Which raises a really crucial point about the distributional impact of all this. Think about how AI is actually used in society. If you are a sophisticated user, say you have a human wealth manager, or you are at a top-tier research hospital, those professionals are using AI as a tool, but they possess the baseline expertise to cross-check its logic.
Right. They can spot the tunnel vision.
Exactly. But everyday people often rely solely on free AI apps to draft legal letters, set up budgeting plans, or triage their health symptoms. They don't have a human safety net.
And this raises an important question about structural inequality. The burden of uncorrected AI bias falls disproportionately on populations who rely on automated tools the most and have the fewest resources to verify those outputs.
So with millions of dollars in foregone growth, severe fair lending liabilities, and healthcare disparities on the line, we have to talk about solutions.
We do.
How do you fix a fundamentally irrational machine? Because if this bias is baked into the neural weights during that RLHF phase, you can't just open up the code and delete the loss aversion file.
No, you can't. It's a neural network, so the logic is distributed across billions of connections. However, Dr. Westover outlines several evidence-based interventions that organizations are successfully deploying right now to navigate around these architectural flaws.
So great.
Yeah, and the first, and perhaps most surprising, is a specific type of prompt engineering called role priming.
Role priming. How does that actually work under the hood?
The automated investment platform Betterment actually tested this. They found that if they simply preface their AI's instructions with a prompt like, think of yourself as a rational investor who makes decisions using the expected utility framework, it literally shifted the mathematical weights the model used to generate its answer.
Wait, really? You just tell the machine to act rational and it suddenly remembers how to do the math?
Essentially, yes. By explicitly invoking concepts like rational investor and expected utility, the prompt activates a different semantic cluster within the AI's training data.
Oh, I see.
Specifically, it activates the hyper-rational, belief-based textbooks and economic papers it read, rather than the anxious human blog posts. Betterment's A/B testing showed a 5.2% reduction in recommendations exhibiting narrow framing just by adding that single sentence.
That is fascinating. We're basically forcing the AI to put on its statistician hat before it speaks.
Pretty much.
Okay, what is the next intervention?
Another highly effective technique is chain of thought prompting. This forces the AI to break down its reasoning step by step, visibly, before it outputs a final conclusion.
Okay.
The pharmaceutical giant Novartis uses this for their AI medical literature assistant. Instead of asking the AI to just summarize a study, the system forces the AI to first extract the raw data, then evaluate the methodology, and only then synthesize a conclusion.
And I imagine slowing the processing down, like that prevents the AI from jumping to conclusions, like avoiding the conjunction fallacy, right? Where we assume that a patient having a cough and a rare disease
Yeah.
is somehow more likely than them just having a cough.
That is the exact mechanism. By forcing the AI to show its mathematical work at every single step, it prevents the neural network from taking those irrational heuristic shortcuts that lead to the conjunction fallacy.
So we have role priming to activate rational data
Yeah.
and chain of thought to force step-by-step math. But earlier you mentioned that different models like Llama and Gemini have entirely different psychological profiles. Is there a way to mathematically combine them so they cancel out each other's flaws?
Yes, and this is arguably the most robust technical solution available today, ensemble methods.
Okay.
The quantitative hedge fund 2 Sigma utilizes this approach brilliantly for their market sentiment analysis. They recognized that GPT-4 had a strong recency bias. It would drastically overweight yesterday's news in its probability models.
Yeah.
They saw that Claude 3 Opus suffered from an availability cascade. If a market rumor was repeated enough times online, Claude would treat it as fact. And Gemini 1.5 Pro was generally less biased, but suffered from severe overconfidence, assigning 99% certainty to events that were only maybe 60% likely.
So it's like putting together a heist movie crew where they all have to vote on the plan.
Mm-hmm.
You know the getaway driver is hyper paranoid, and you know the safecracker is just arrogant and overconfident. But when you put them in a room together and force them to agree, the paranoia dilutes the overconfidence, and the average of their votes becomes the perfect balanced decision.
That is exactly the mathematical mechanism of an ensemble method. 2 Sigma created a weighted algorithmic ensemble of all 3 LLMs.
Wow.
When they ran the same market data through all 3 and averaged the resulting probability distributions, the spikes canceled each other out. The recency bias of GPT mathematically offset the overconfidence of Gemini, and the resulting analysis was vastly superior and more rational than any single model working alone.
That's a brilliant workaround. But even with clever prompt engineering and multi-model heist crews, organizations still have to make a deeper philosophical choice about how they want their AI to behave in front of a customer.
Right. They do. And this is where the conversation moves from technical fixes to workflow governance. Sometimes human bias and machine bias are best mitigated by carefully dividing the labor.
Makes sense.
Fidelity Investments provides a perfect case study for this. They use AI strictly for the cold, hard math tasks like tax loss harvesting and portfolio optimization, where you absolutely want a hyper-rational, expected utility maximizing agent.
You let the calculator be a calculator.
Precisely. But they intentionally leave the preference elicitation and client communication to human advisors who possess actual empathy and ethical reasoning.
Right.
They also built in systemic rationality checkpoints. If the AI flags an output that hits a certain risk threshold, a human must review the logic before any trade is executed.
That's smart.
Kaiser Permanente takes a similar approach in healthcare. They use a clinician feedback portal where doctors can flag AI behavioral drift in real time, catching an availability bias before it becomes a systemic triage issue.
It's really about choosing the right alignment for the specific task at hand. The article mentions the robo-advisor Wealthfront coming to the realization that there is no one-size-fits-all AI model for a business.
Yeah, and if we connect this to the bigger picture, Wealthfront realized they needed multiple personas. They use strictly rational, mathematically optimized AI for constructing the actual portfolios.
Right.
But when a customer asks a question about saving for their child's college fund, they route that query to a human-aligned, empathetic AI model. A coldly rational, probabilistic explanation of market volatility might terrify or alienate a normal user.
So what does this all mean? It means organizations need to stop treating artificial intelligence as a simple IT procurement issue and start treating it as behavioral management.
That is the ultimate takeaway from Dr. Westover's work. Recognizing AI as an economic agent means leaders have to stop using the algorithm as a liability shield. You can't just throw up your hands and say, well, the computer said so.
Right.
Firms like McKinsey are adapting to this by physically pairing machine learning engineers with behavioral economists to build these AI systems. You really need the technical understanding of how neural weights shift, combined with the psychological understanding of human cognitive bias, to deploy these models safely.
Which means if you are deploying this in your own business right now, or even just asking a commercial chatbot for budgeting advice, you have to actively decide what kind of agent you need in that moment. Do you need a human sounding board that understands nuance and anxiety, or do you need a rational statistical calculator?
Exactly, because right now, the AI is blending both, often in invisible ways that can quietly sabotage your decisions.
It fundamentally changes our relationship with the technology. We are no longer just checking the output for factual hallucinations. We have to actively interrogate the output for behavioral bias.
Yep.
It's a whole other can of worms.
We've taken a really serious deep dive today into the realization that AI is not a neutral, emotionless machine. Because of the way we trained it, specifically through human feedback, it has developed a distinct behavioral economics profile.
It really has.
It is hyper-rational in its beliefs, calculating base rates and Bayesian probabilities better than we ever could. But it is remarkably human and mathematically flawed in its preferences. It has read our entire history of irrational choices, and it has learned to reflect our own financial anxieties and cognitive shortcuts right back at us.
Completely.
Which leaves us with one final lingering question to mull over. Let's say the engineers at these massive tech labs figure it all out. Let's say they successfully strip the next generation of AI of all its human-like irrationality, completely removing its loss aversion and biases. They turn it back into the perfectly logical, utility-maximizing machine we originally thought it was.
If they do that, do we risk creating a system that is so coldly rational and so perfectly mathematical that it can no longer understand, communicate with, or accurately predict the highly irrational human markets it is supposed to operate in?
That is the million-dollar question.
Thank you for joining us on today's deep dive. Next time you open up that chat window, don't just ask if the answer is factually right. Ask yourself if the machine is acting rationally.